Nick Purves is fund manager from Temple Bar, and joins us now. And as we've been hearing, it's interesting looking at some of the economic context. I know you're going to be talking about this amongst other things. Nick, over to you, and we'll get on to your questions in about 20 minutes' time. What have you got for us?
Okay, hi. Good morning. Yes, as you say, I'm going to talk about Temple Bar this morning for about 20 minutes or so. Just for those who aren't familiar, Temple Bar is it's a UK-centric investment trust. When I say UK-centric, what I mean is about 70% of the trust assets are invested in UK equities. The trust, I suppose, what makes it quite distinctive, we think, is it adopts very much what we call a value style of investing. Value style investing basically means involves investing in the more lowly valued companies, in this case within the UK market. Why do we invest in lowly valued companies? We invest in low value companies because there's an enormous amount of empirical evidence to show lowly valued companies, lowly valued stocks, do actually give you higher levels of total return, total investment return over time. It's worth asking the question, I suppose, why is it, why should lowly valued companies offer you higher levels of total return over time, given that often they exist in quite challenged industries? Simply, we think it's because of behavioural biases amongst most investors, whereby they become overly optimistic about the prospects for the very best companies in the market. At the same time, they're too quick to give up on or become overly pessimistic about the prospect for companies that are seen to operate in more challenged industries. The end result of that is that actually, some of them, often the most popular companies in the market, end up disappointing high expectations, whereas some of the more challenged companies, the more lowly valued companies, end up actually exceeding or surprising positively what are low expectations, and that, of course, would lead to the outperformance of lowly valued shares. And when I said earlier on that there's an enormous amount of empirical evidence to show that lowly valued stocks do provide an excess level of return, this is I suppose one of the many proof statements of that. This looks at the US market over the last 100 years. Each box represents an individual year, and the number gives you the excess return in that year of investing in lowly valued companies. You can see the annualized excess returns by decade along the bottom there. So I suppose a blind value strategy of investing simply in the most lowly valued companies has been shown over time to deliver some quite significant levels of excess return. Obviously, with periods where actually lowly valued stocks don't do so well, and the 2010s were a good example of that. And we've had the honour of looking after the Temple Bar Investment Trust for 4.5 years now. We took it over actually towards the end of the COVID period in November 2020, and that period has been a good period for value investors generally. So we have been successful in generating some very significant excess returns for the trust's shareholders over that period, roughly doubling the 70% return that's been available on the wider FTSE All-Share Index. But again, I think, as you instinctively know, there's a lot of randomness in stock markets, and it's important then, therefore, to extend your horizons, your time horizons, as long as you possibly can, because obviously, the longer the time horizon, the less of element of chance or luck involved. And this actually represents the track record of our longest standing client, coming up to 25 years, where we've managed to turn an index return of around 5% per annum into a fund return of around 8% per annum, and because of the miracle of compounding, that 3% per annum over 25 years, that 3% per annum difference more than doubles the return that's available on the wider index. And I suppose the important point to make is that we've adopted a very consistent value-oriented strategy throughout that 25-year period, and there's nothing that we see in the markets today. Yes, of course, all investment strategies go through good and bad periods, but there's nothing that we see today that suggests that in the next 25 years, we live long enough to see it, that we shouldn't be able to continue to add excess return for the trust's shareholders by adopting a value strategy. So I suppose turning to today, where do we think, where does broadly the undervaluation or the low valuation reside today? Well, we don't think it resides in the US stock market. I'm sure all of you be aware that the US stock market has performed extremely well in relative terms over the last 10 years or so. That's obviously shown on this chart, and partly as a result of that, you can obviously measure this. You can measure valuation in different ways, but this measure of valuation, which I suppose is a fancy way of measuring market capitalization of the US market to US GDP. This and a number of other valuation measures shows that the US market is looking extremely highly priced today, and on some measures more highly priced than it's been pretty much throughout its entire history. So all other things being equal, we don't think that as value investors you should be hunting or spending too much of your time, or you shouldn't have too big a portion of your portfolio invested in US assets. But of course, as we know, in the real world, we see almost exactly the opposite. The US market today makes up around over 70% of the MSCI Global Index. So a passive investor would have around 70% of their money invested in the US market at a time when we would say the US market has never looked more expensive. And if you do believe, obviously, that starting valuation is over the long term the best predictor of future return, which is certainly what we believe, then that is, we don't think that's likely to be an optimal investment strategy going forward. The UK market, obviously, the challenges surrounding the UK economy are very well known. We've had obviously various headwinds come up against various headwinds. Obviously, we had the Brexit vote in 2016, sluggish economic growth, etc., etc. And of course, and it's not surprising perhaps that sentiment towards the UK market, and the UK market is not alone, by the way, but the UK market sentiment is pretty poor. The result of that is that the valuation attached to UK stocks stands at a pretty significant discount to that of the MSCI of global equities generally. And it's always difficult to measure these things precisely, but on this measure, UK stocks as a group standing at around a 40 to 50% discount to the global average. So we think that, again, all other things being equal, the UK market should be a relatively fertile hunting ground for lowly valued companies. And of course, remember, of course, so far I've been talking about the wider markets. Of course, we're trying to cherry pick individual companies within the UK market, which look particularly attractively priced. And this is of the trust's portfolio today. This is how it breaks down by sector. You can see the biggest exposures are financials, and that includes both insurance companies and banks, and also one asset management company. The energy companies we think look attractively priced today on a reasonable expectation of long run oil and gas prices. Consumer discretionary, that would be retail stocks, auto stocks. Obviously, those companies are having to and have had to contend with very significant challenges over the last few years. And then finally, consumer communication services, that would be companies like telecoms and media. That is where we believe that the most attractive valuations reside. But of course, we don't buy markets. We don't invest the trust assets in markets. We don't invest in sectors either. We invest them in individual companies. And you'll be give an example here, Johnson Matthey, and you'll be relieved here. I'm not going to go through this slide, but except to say this is the type of company that we are looking for. Johnson Matthey is, for those of you that haven't come across it, it's basically a chemicals company. It actually has some strong market positions in various sectors, in auto catalysts, in industrial catalysts, in platinum and group metals, and even hydrogen. But we don't think that it's a company that's been basically living up to its long run potential, and as a result, it had become very lowly valued. So at the time we invested a couple of 2 or 3 months ago, the company was valued around 9 times earnings and on around a 6% dividend yield. I don't know if you've seen, but actually in the last couple of weeks, the company announced that it's selling its catalyst technologies business to Honeywell for £1.5 billion. The interesting thing about that is that £1.5 billion represents about 2/3 of the company's market capitalization, and yet the bit of the business they're selling accounts for around 25% of the group profits. And this is again, just sheds a spotlight on the attraction to investing in lowly valued companies where expectations are low and where the element of positive surprise is that much greater. And the day that they announced that sale, the sale of that division, the share price went up by around 30 to 35%. But a good example of the type of company that we're looking for. If you invest in lowly valued companies, you should expect, all other things being equal, to see a high number of takeover bids for companies in the portfolio, especially in a country like the UK, which is relatively friendly, we would say, to outside capital. And you might or might not be aware, but the number of takeovers of companies by either private equity or foreign corporates of companies in the UK is pretty much sitting at a record high. And we think an indication, again, of the low valuations that exist in the UK market today. So the trust benefit had 4 of the companies in the trust portfolio in 2024 were bid for. Anglo-American Currys, Direct Line, and IDS, that's the old Royal Mail. IDS has gone through, Direct Line will go through. Anglo-American, the bid for Anglo-American by BHP didn't succeed, and neither did the bid for Currys. But in both cases, the share price is significantly higher than where they were pre those bids, which didn't succeed. And I suppose it's an obvious thing to say, but those 4 bids, 4 companies in the portfolio, it created a lot of value for the trust's shareholders last year. So again, an advantage of investing in lowly valued companies, you should expect to see more than your fair share of takeover bids for companies in the portfolio. Another factor that can drive returns, of course, is share buybacks, and share buybacks are particularly efficacious, particularly value enhancing when valuations are low. And because valuations are low in the UK market, it means that around 40 to 50% of companies in the UK market, by number, by the way, are using the cash flows that they're generating to buy back cheap stock. And so you have to think about it a bit. But the way that this adds value for those shareholders who choose not to participate in the share buyback is, of course, if a company buys 5% of its shares back in any 1 year, what it means, of course, is that the number of shares in issue reduces by 5%, and what that means is every pound of profit generated next year is worth 5% more to the remaining shareholders in earnings per share, terms. So it drives, as I say, if providing that the share price, the valuation is low, it drives significant amounts of future value for the shareholders that choose not to sell into the buyback. The number of companies in the Temple Bar portfolio that are buying back stock is around 60% today. And we think a real source of future value creation for the trust shareholders. You can actually add. You can take your dividend yield, which we're all familiar with, obviously. You can add your buyback yield, so that of course, for the market as a whole, the proportion of the market as a whole, which has been basically being retired through share buybacks in each and every year, and you can add those two together to get what we call a total yield. Total yield in the UK market is around 6%, more than double that available in the US there on the right hand side. And just remember, as an equity shareholder, what are you looking for? You're looking for around a high single digit annual total return, so probably 8-9%, let's call it that. Well, if you're looking for 8-9% and you're getting 6% through a total shareholder yield, this is before the benefits of any underlying growth in profits that the company might be able to generate, then we think that sets you in very good stead. The poster child, if you like, for value creation when it comes to retiring cheap equity and just returning money to shareholders in a very disciplined manner and driving spectacular long-term shareholder returns is Next PLC. We don't own Next PLC in Temple Bar, but we think it's a very good company. We think it's fairly valued in the stock market today. But the reason we show this slide is because it's basically it shows what's possible from what you would describe as a good, but certainly not spectacular business. So when we say not spectacular, you can see on the left there, Next over 25 years, 2000 to 2024, generated around 5 to 6% per annum sales growth, a little bit more than nominal GDP, but certainly not spectacular. But it turned that, because it kept buying back shares and reducing the number of shares in issue, it turned that into earnings per share growth there, in the middle there, of around 12% per annum over that 24 years. Add in around a 3% dividend yield, and you take your 12% earnings per share growth plus your 3% dividend yield, and you get a total return of 15% per annum, and you compound that over 24 years, and it gives you the share price chart that you see on the right. A share price that went from £5 around 25 years ago to over £100 today, and of course the share price chart excludes the dividends that you've been paid along the way. So I suppose the message we're trying to get across is you don't have to invest in sexy growth businesses to enjoy spectacular returns. You have to invest in reasonable businesses that generate a lot of cash and where the management teams are laser focused on using that cash to drive shareholder value. And that is the sort of companies that we look for today. We relieved here. I certainly don't want to go through this list of companies, but this is the top 10 holdings within the Temple Bar Trust, around 50% of the trust portfolio. And this is a collection of companies that we think have the wherewithal to deliver the enormous benefits of compounding those shareholder returns over time, coupled with some underlying profit growth. And as I say, it's these companies that have the characteristics we look for. So they're reasonable businesses, not necessarily spectacular businesses, but reasonable businesses generating a lot of cash, good balance sheets, solid finances, and management teams that get it and are using their cash flows to drive value for the trust shareholders. And I think from there, I'll take any questions.
Yes, thanks so much indeed. Interesting, and it has brought some questions in, as you can imagine. I want to talk first of all about the broad economic picture, as I said, and I think this is a point worth mentioning because we've mentioned it to some of the other guests as well, and the degree, whether you consider the wider economic cycle, the threats from excessive public indebtedness and slowing growth, what effects have all that had on the investment environment here in the UK?
I always find these questions hard to answer. I mean, the honest answer is that none of us know what's going to happen when it comes to the macro. I mean, it's a fair statement to say that I think, obviously government borrowing in the UK and many countries in Europe and indeed the US is, you could argue that it's too high. But that, and it could be, and obviously that increases the risks of some sort of, I suppose, financial crisis at some point down the track. But of course, none of us know what, when that might come, the response to it, how companies themselves can adapt to that, can adapt to that environment. And I suppose the future is always hugely uncertain. I mean, it's why shareholders get paid net to risk premium for holding shares. It's why the bond market will, on average, give you a 4 to 5% annual return, and equities generally will give you a 9% return. The reason you're getting that extra 4 to 5% return is because you're being basically paid by the market to take on additional risk. And I think we think it's very, you have to stick to your sphere. We think you have to stick to your sphere of competence, and we would absolutely encourage investors not to invest based on a macro view, because if you did that, you'd be basically buying the market when conditions were good, macroeconomically in 2007. You'd be selling the market when conditions were bad in 2009. You'd be buying the market when conditions are good in 2019. You'd be selling the market when conditions were bad in 2020. So we would actually encourage people to not have a macroeconomic view, but actually use macroeconomic volatility to your advantage, where it basically means that shares are trading, individual companies are trading too cheap.
Let's pick up as well on a point you mentioned about your willingness to steer the portfolio away now more from US companies, because you think perhaps maybe that overvaluation, or perhaps maybe the good run that we've had has passed, and it's now really an opportunity now to take a look at perhaps maybe assets closer to home. One of the questions is, given the FTSE 100's resilience after Trump's tariff announcement, how much happier are you being a UK investor now than a year ago?
Everything to us comes in the form of valuation. So the portfolio as a whole is valued on a PE of about 9 today. So if you on a weighted average basis, the portfolio is on a PE of 9. So that means that it's got an earnings. You flip it over, it's got an earnings yield of 11, which of course we think is a very attractive number. And obviously, we think there's a little bit of earnings growth in there as well. So we think that the portfolio today is priced today to give you some attractive returns. What we're absolutely not trying to do is make market calls. So we are not saying that the US market is expensive, therefore it's likely to. It means the market's going to fall in the next 12 months. We just don't know that. I mean, the US market has looked expensive for some time. What we're saying, and it's important that we get the language correct. What we're saying is today, US stocks as a group, not all of them, but US stocks as a group are not priced or valued to give you attractive future returns. Whereas as I say, the stocks, many stocks in the UK, and particularly those in the trust, are priced today to give you attractive future returns. Of course, there'll be volatility along the way. That is part and parcel of equity investing. And so, when the questioner asks, how do we compare the portfolio today to a year ago, for example? Well, a year ago, actually, the portfolio was even cheaper. It was on a PE of 8. So, all other things being equal, we would say actually marginally, we think actually there's less excess return probably priced into the portfolio today than there was a year ago. But then the trust gave you a 20% return last year.
Yeah.
So you should expect the valuation to be a bit higher.
Yeah. Added to that question, Nick, there was also, do you think there's a preference for UK versus US now, and how long could it last? I think this is an interesting crystal ball question, and I think it's obviously something you're going to be considering as a manager of a fund manager. How do you see the next year or so developing? Yes. The question says, do you think there's a preference of UK versus US now, and how long could it last? Basically, that's what the question is.
As long as so we will prefer UK and other markets to US equities generally, as long as the valuations point us in that direction. So as long as the valuations are significantly lower, which they are today, then we will continue to be more positively disposed to those markets. Everything is, and I know everything is driven by value. Everything is driven by valuation, because we just don't know. We just don't know. As an example of how little we do know. Remember the 1st of January when everyone was talking about US exceptionalism. They're not talking about it. We're 4 or 5 months later. They're not talking about that now.
No.
Now everyone's worried about the US because, Trump was elected in November. All the Trump trades just took off because Trump was seen to be good for corporate profits, and the US market went up on the back of it. And now here we are 6 months later, and everyone's changed their mind because actually, people are thinking, well, tariffs, taxes, that's bad for corporate profits. And actually now, there's some signs that people are turning away from the US market. So it's just impossible. It's just impossible to know what is around the corner. So you take your cue from valuation. That's the way that we think.
Yeah. So as UK value investors, how much do you balance the pursuit, this question says, of capital appreciation growth versus income?
Oh, okay, yeah, no, that's a good question. We think about everything in terms of total return. So it's we don't really, obviously the trust pays a dividend, and it's very important to the board and the shareholders that dividend continues to grow. So we manage dividend, the trust dividend, very carefully, but at the portfolio level. In each individual company in the portfolio, we don't distinguish between income and capital or growth in income, depending how you want to think about it. For us, it's the quantum of total return that's the important thing. And I suppose it's important to highlight, we would never put dividend before total return. Does that make sense? So we would never invest in a company purely by virtue of the fact that it pays a nice dividend, if we don't think the total return prospects of the share basically match up to what we expect.
Yeah, well, interesting enough, actually, we've only got one question come through about one particular stock. Well, that's going to change now, I've mentioned that. But the question says, and in fact, it relates to this, is what's up on the screen at the moment, ITV particularly. Are you concerned about ITV's advertising business detracting from the studios? Would you like to see a breakup of this company so you get better opportunities in specific areas?
Difficult one. I think just to sort of get a little, I think the questioner is right to worry about advertising trends within ITV's broadcast business. We all know that the advertising market is difficult, both from a cyclical point of view, but also actually from a secular point of view. There are obviously very profound changes going on there with in the way that we all consume television, and that has a very profound effect on ITV. Despite the fact that actually ITVX, its digital offering, is proving to be very successful. But I think again, you have to bring it all back to the starting point of valuation. If I told you that ITV has a market capitalization today of around just over 3 billion, Its studios business. Now, studios business, that is a good business. That is a good business. ITV Studios, number 2 independent production company in the world, not just in the UK, in the world. That bit of ITV Studios business generated around 250 million of operating profit last year. You would normally, that is probably on its own worth 3.5 billion quid. Okay, so if they sold that, and there'd be plenty of buyers for it, by the way. You get where I'm going. So you can see the advertising business, the broadcast business of ITV is not being accorded any valuation. This goes back by the stock market, and this goes back to what I was saying earlier about basically the bar of expectation is on the floor. Yes, the broadcast business is challenged. It's not going away. I mean, it generated, I think, 250 million of profit last year. That might be worth. I mean, you wouldn't value that in the same way as you value studios, but you might value it at that could be worth 2 billion certainly. And
that's incredible. I've just been looking up the market cap of ITV today is 2.86 billion. So that just goes to show when companies are made up with different parts, how important it is to make sure you get the correct valuation.
Absolutely right.
Do you think a split up is likely?
We don't know. But it's a bit like Johnson Matthey. You walked in one morning and it happened, and someone's bid for it, and share price is up 40%. You absolutely wouldn't be at all surprised. And management are very focused on. They're doing a good job, I've seen, in a pretty difficult set of circumstances. But they are very focused on shareholders. They will do what they think is right for shareholders, and if they think it's right to split up the business, that's what they'll do.
Fascinating. Really interesting dynamic going on. Nick, we'll have to leave it there, but thank you so much indeed for joining us. Fascinating talk through the Temple Bar Investment Trust.